has Asia learned from the global financial crisis? How would an Asian regulatory model be different? Would it serve Asia's changing needs? Where should Asia look for inspiration? Introducing Mr. Mark Tucker, Group CEO and President of AIA.
What is the intent? To walk that through? Let me come back. I'll stay and introduce you.
Okay, I'll stay. Yeah.
I'll stay here and introduce you. Okay, if we can begin this session, please. I think welcome back after the break and welcome to this plenary discussion in search of a better regulatory model. My name is Mark Tucker. I'm the CEO of AIA Group, based here in Hong Kong, and I will be the moderator for this session. Let me start by giving you just a brief introduction of our distinguished speakers this morning. First, we have Andy Haldane, who is Executive Director for Financial Stability at the Bank of England. Andy has been at the bank since 1989 and has written extensively on domestic and international monetary and financial stability. He is also a member of the bank's Financial Policy Committee and the Basel Committee. He's also welcomed Richard Koo. Richard is Chief Economist of Nomura Research Institute in Tokyo. Richard has been with Nomura since 1984 and previously worked at the US Federal Reserve. He has published extensively on global economics as an expert on Japan and has advised several Japanese prime ministers. I would now like to introduce David Wu. David is a member of PwC's China Management Board and is based in Beijing. As an expert on the Chinese regulatory and market landscape, David works closely with the ministries and government agencies that oversees China's financial services industry and capital markets. And last but not least, to introduce Stan Fischer, or to reintroduce Stan. And I think, again, Andrew gave him a long introduction this morning. Stan, if I can keep to a very short one, it's enough, okay. I think Stan is very well known. Our topic today is a better regulatory model for Asia. And in the wake of the 2008 financial crisis, and as the global economy rebalances to take account of the increasing economic strength of Asia, there are many questions about regulation to both ask and answer. Can the region's systemically important economies be expected to exercise greater influence over global regulatory reforms than in the past? Does emerging Asia's role as a source of capital for the developed world give Asia the opportunity to design a more appropriate global regime? Or is the idea of a global cure a dangerous illusion? How valid is it to think in terms of global remedies when our experience is that one size rarely fits all? And is the priority to take a regional view and develop Asia-specific regulatory models designed to serve Asia's own economic development needs? It's a fascinating and clearly an important subject. As you've heard, we've assembled a great panel of international experts who I know have all the answers. I'm going to start by asking each of them, starting with Andy, and then Richard, and then David, and then Stan, to address the topic for about 10 to 15 minutes. Then we'll moderate a short discussion amongst the panelists before opening up the floor to questions. So I can now hand over to Andy.
Well, thank you, Mark, and good morning, everyone. It's a real pleasure to be here. A particular pleasure, actually, because the last 2 days prior to today, I've been at a Basel committee meeting in a darkened room around 300 yards that way, locked in for a whole 2 days. Imagine this, please. 70 regulators discussing the definition of the leverage ratio. So this is really light relief. Emerging from purgatory into heaven. So very nice to be here. I want to make 4 observations on regulatory reform and what it means for Asia, 1 backward-looking observation, and 3 more speculative forward-looking observations on regulatory reform and how it might apply in an Asian context. So the first point is my backward-looking point. Obviously, over the course of the last 5 or so years, there has been a slew of regulatory reform in the light of the biggest global financial crisis we are likely to see in any of our lifetimes. During that regulatory reform process, on average, Asia has punched below its weight. But I'm not sure that has mattered too much. Why do I say that? Well, because many of the key elements of that regulatory reform agenda, such as Basel III, mentioned this morning, were already largely embedded in Asian banks even prior to the crisis. This is the benefit of Asia having got its crisis in first. Indeed, one of the reasons why Asian banks performed relatively better was precisely because some of that insurance was already in place prior to this time's crisis. And that was a contributing factor to Asian economies also outperforming during the crisis. And to see that, I mean, just think about Basel III as comprising basically 2 elements. So one element was higher capital for all global banks. But actually, most Asian banks already had that fuel in the tank even prior to 2008. Their capital ratios were 2, 3, in some cases more percentage points above the equivalent ratios in Europe or the US. And the second key dimension of Basel III was what you might call a macro-prudential overlay. So this was a recognition of the importance of the interaction between regulation on the one hand and the wider economy on the other. The first time, really, the join between the two has been explicitly embedded in a regulatory framework. For example, it's now expected, anticipated in future, that regulation would overtly lean against the cycle. It would seek to constrain risk-taking during the booms and to cushion risk-taking during the busts. And while that is a new lesson for Western banks, of course, for many banks across Asia, this was an old lesson. Many countries across Asia were executing what was effectively a macro-prudential regime well ahead of the global financial crisis here in Hong Kong, in mainland China, in India, in Thailand, in Korea, and elsewhere. This leaning against the wind in the setting of regulatory policy was already embedded in the regulatory framework. So, 2 implications of the regulatory reform initiative. In some ways, it could be interpreted as the Western banks, converging on a pre-existing Eastern regulatory model. So in the language of football, if there's a football match, the regulatory score would be Basel 3, Asia 4. The bigger philosophical shift, though, is that one I mentioned. It's the recognition of this symbiotic relationship between regulation on the one hand and the wider economy on the other. It's the recognition that the financial sector is there as servant of the wider economy rather than as master, as a means to an end rather than as an end in itself. And what applies to the financial sector applies equally to regulation of the financial sector. In other words, the lens through which we should view regulatory reform is whether that regulation best equips the financial sector to provide its essential services to the wider economy. And it's on that theme I wanted to make 2 or 3 forward-looking observations about where next we may look to make changes to the regulatory framework we've put in place post-crisis, in a way that would both support growth while at the same time keeping the system safe and sound. Those twin objectives of growth promotion and the mitigation of systemic risk. So point 1, if you look at the existing regulatory treatment of different of banks' assets, it paints a slightly odd picture. So imagine think for a moment of the regulatory treatment of exposures directly to the economy on the one hand, and exposures elsewhere in the financial system on the other. Pre-crisis, we saw the biggest ballooning of bank balance sheets that I can find anywhere in the record books. But even more striking than the scale of that ballooning was the sorts of assets banks went into. So say, take the UK banks, which are by no means atypical. 2/3 of that balance sheet expansion was lending to elsewhere in the financial system. And of the remaining third that was to the wider economy, 80% of that was backed by property, commercial or residential. And that story, that balance sheet expansion, the composition, is pretty much mirrored elsewhere as well. So why was that the case? Why was that ballooning gravitating not directly into the real economy, but to elsewhere in the financial system or to property-related loans? Well, one key reason is that you need look no further than the regulatory framework, because that puts in place pretty direct incentives for assets to end up as they ended up. So take, for example, the capital a bank might be required to hold against a company exposure, a large company. If that is a non-financial company, the amount of capital a bank would be required to hold is on average around 3 times that would be held against a financial company. For an SME, the multiplier would be larger still. For property exposures, the capital you're required to hold is a tiny slither of that which you'd be required to hold against an unsecured loan to an SME. And the key point here is that the existing regulatory apparatus does not seek to fully embed some of the broader economic and social benefits that may come from particular types of exposures. or in the language of economists, those broader externalities, positive or negative, are currently not embedded in regulatory design principles. What might that mean? Well, take loans to the wider economy. Because they are growth positive, they could be said to impart a positive externality, a broader social and economic benefit. I'm talking trade finance. I'm talking infrastructure financing. I'm talking lending to mid-cap corporations. I'm talking project finance. Regulation recognizes the risk in that lending, but makes no allowance for the return, the economic return, the social return that may flow from those exposures. And conversely, if you think about loans within the financial sector that aren't directly supporting the economy, the existing regulatory framework does not embed the negative externalities they may impart. Externalities that may result from long chains of interconnected exposures between counterparties, the like of which brought about the economic crisis. They take no account of the increased complexity that arises often from intra-financial sector exposures. So a benevolent social planner, taking account of those social costs and economic benefits, would, I think, be imposing an extra regulatory penalty on intra-financial system exposures and a regulatory discount on economy-facing exposures, which is the complete flip of where the current regulatory framework sits. That is an issue to which we as regulators need to turn in future if regulation is there as a means to an end, as a means to supporting the wider financial system. I'll skip over my second point and go straight to the third one, actually, in the interest of time, which concerns not banks, but non-bank regulation. So a stylized fact of the Asian financial system right now is that it's really quite bank-centric. So if you look at the fraction of financing that comes from the banking system, in Asia, in most countries, that's often around 60, 70, 80%. Similarly in some respects to most of Europe, actually, but much higher than the corresponding number in the US, which would be 20 or 30%. So a large degree of bank centricity of the financing model. And if you look at the pie chart of non-bank intermediation globally, Asia accounts for little more than 10% of global non-bank financial intermediation, so well short of Asia's GDP share, which would be closer to a third. So we have a situation where within Asia and indeed within Europe, there's a very great reliance on banks as a source of financing to the broader economy. Is that a smart model? Well, European experience suggests it is not always a smart model because it gives you a financial engine with only one cylinder. And when that cylinder breaks down, you find the wider economy starved of credit. That has been a large part of the reason why European growth has lagged elsewhere in the world over the last few years. And one reason why the US has emerged that much stronger is because its financial sector had a second financing cylinder from non-bank sources, from capital markets in significant scale. And that second cylinder has fired and has generated greater growth in the US and Europe. So one idea, one proposal is, would it not make sense for Asia too to develop this second cylinder? It could be corporate bond markets, deeper, more liquid corporate bond markets. Currently across most Asian countries, corporate bonds are at max around 30% of GDP. In many countries, lower than that. In Europe, the corresponding number would be 40%. In the US, the number would be 90%. So the corporate bond market is somewhat underdeveloped across Asia. To a lesser extent, that is true of equity markets. And it's certainly true of the market for securitizations, the bundling together of assets for onward purchase by real money investors, insurance companies, pension funds, sovereign wealth funds, and the like. The securitization market in Asia, as in Europe, has slowed to a trickle. And this securitization market could really make a difference. As US experience demonstrates, it can be used to bundle almost anything. It could be car sales. It could be credit card receivables. It could be student loans. It could be infrastructure projects. It could be SME loans. It could be mortgages. It could be all of these and more besides, placing those assets in the hands, not of banks, but of real money investors who require both duration and yield. And securitization can pull off that loaves and fishes miracle of delivering both duration and yield, provided the instruments are simple and safe. So the question then becomes, what would it take to deliver such a vibrant, non-bank set of channels for intermediation in Asia? Well, I don't know all the ingredients, but they're likely to include, I think, much greater degrees of cooperation and coordination cross-border. It would be, idealistically, what you're seeking here is something that is as close as possible to, if not a single, then at least a homogeneous set of capital markets for these instruments. That will require thinking about coordination between securities regulators in Asia. It will mean thinking about harmonizing listing rules. It will mean thinking about common rules for the clearing of these instruments. It will mean thinking about making as homogeneous and standardized as possible the underlying products. It will mean thinking about harmonizing or homogenizing to a greater degree legal structures. That is a long list, a very ambitious list, but it is the self-same list that Europe has been working on over the last 20 years in seeking to create its own homogeneous set of capital markets. And if ever there were a time to be ambitious about such a grand project, it is now. Given the needs of the wider economy for financing, given the need for a more diverse financial sector that has two cylinders rather than one, given the costs of the crisis we've all been living through. That is quite a big prize, but one for me that it'd be well worth seeking out. Let me stop there. Thank you.
Good morning. Thank you very much for having me here. I think there was also a communication mistake with the organizers, because I'm usually asked to talk about balance sheet recession, the concept I developed to describe what happened in Japan, what's happening all around the world. But for somehow I was asked to talk about bank regulation in this event. But I also have this highly dishonorable background of being involved in two massive banking crises during the last 20, 30 years. First one was the Latin American debt crisis, which started in 1982. And for those of you who are old enough to remember how bad that was, 7 out of 8 US money center banks were all bankrupt on August 1982. And I was in the middle of it because I was the syndicated loan desk officer at the New York Fed when all those loans to Latin America went bad. So I got a little bit of shock just 1 year out of my graduate school about what the real world is really like. And then when I moved to Japan got its banking crisis, a massive one. Japanese commercial real estate fell 87% nationwide. Now, when you think about that, what kind of banking system or economy, for that matter, you have at the end of the day? So I had to deal with that one based on my experience in the United States with the Latin American debt crisis. So those two experiences taught me a lot about bank regulation, how to deal with banking crises. And what it taught me was that there are actually two types of banking crises, the ordinary types and the systemic one. And the difference between the two is that in an ordinary or localized crisis, only few banks are bad, but the rest are okay. And then in that case, you move in quickly with disposal of non-performing loans and things like that. But those two that I had to deal with myself were both the other type, where all banks have the same problem at the same time. And in that case, I call this the 95% problem. It's not the 5% problem, but the 95% of the banks have the same problem at the same time. Then you have to go slowly, because the option of shutting down the economy doesn't exist. And in the case of Latin American crisis, and this is what Paul Volcker taught me because he was in Washington handling it. I was the person who was doing all the dirty work in New York. When Mexico went belly up, just prior to that, so that was Friday, so Thursday, until Thursday of that week, we were telling the American banks to get the hell out of Latin America. Because in those days, they were all run by military dictators or something close to it. They had horrible current account deficit, horrible budget deficit, inflation going through the roof. So we were the New York Fed was telling them to get out of those countries as quickly as possible from 1979 all the way to 1982. And we were completely ignored. And they doubled the exposure during this period. So when the crisis actually happened, we said to ourselves, yes, we have finally proven correct. Now we're going to get these bastards back home. Well, sorry for the language, but that's how we felt at the moment. We got a call from Paul Volcker, who said, don't allow a single US bank to move out of Mexico. Anyone with exposure of more than $1 million must continue lending to Mexico, knowing fully well that Mexico is completely bankrupt. And God, we were so shocked by that directive. We didn't know what to do. But at that time, the New York Fed had this computer system where we could quickly check the capital exposure of US banks to various countries. And sure enough, we were in the 95% problem, not the 5% problem. So we all had to go on the phone telling the banks, we're all in this together, please continue lending. And we had to make sure that not a single US bank would actually walk to the federal district court to have the judge declare Mexico in default, because if something like that happens, the judge has no choice because it is true. And if it's declared default, then the whole rescue package would have collapsed. So all of these things we had to do, some of them were probably highly illegal, but we had to do it to save the whole system. And we had to call all the central banks around the world to make sure that they will tell their banks to keep credit lines open to the American banks, knowing fully well that American banks are all bankrupt. And so that's the kind of thing we had to do in the US case. And then it took about 10 years to make them strong enough to be able to dispose their problem loans through the Brady Bonds arrangement. That's 1989. But during that 7-8 years, we had to do all the things, legal, illegal, paralegal, you name it, just to make sure that US banks won't collapse. But I think we did a very good job. We never had to go to Congress for money. So average Americans, average academics, average practitioners outside the banking area never knew that 7 out of 8 US money center banks were actually bankrupt during that whole period. Then I moved to Japan, and we got into was exposed to the same problem. As I said, 87% of the asset prices down, and you can imagine what state the Japanese banks were in. So I proposed capital injection right away because there was a massive credit crunch going on at the time. I was able to do it because I did not have a Japanese surname. It's a very unpopular thing to propose, right? It's politically completely incorrect. But because I didn't have a Japanese surname, I was able to do it. And I was able to convince the parliament, get this capital injection in place, and we were able to come out of that crisis. And I was very much helped by Paul Volcker in this process because he wrote to the Japanese in one of the major magazines, it's called Toyo Keizai, where he said, don't listen to those American cowboys who don't know what they're talking about quickly removing the non-performing loans and so forth. You have a systemic banking crisis. You have to go slowly. And he actually proposed that Japanese come up with a speed limit on how fast the banks can write off problem loans. Speed limit. Because if you don't put a speed limit, the banks try to get rid of the problem loans as quickly as possible, then you enter a fallacy of composition problems because everybody will be dumping their assets all at the same time. Asset prices will collapse, the balance sheets will collapse, and the whole economy will collapse with it. So the point is, if you are in that kind of crisis, you have to go slowly, and you have to save the entire banking system. Now, how much of that was actually understood in the current crisis after 2008? And I must say, very little. Apparently, all the tools that we used to save US banking system in 1982 Latin American debt crisis, the institutional memory was completely lost from the Federal Reserve. So some of the top people, including Chairman Bernanke and others, had no access to that experience or information. And so they went by the rules, you need a resolution authority, we don't have it, so we have to get rid of, or let Lehman collapse or things like that. That was very, very unfortunate. Because if the tools that we used in the Latin American debt crisis were known to the people who were running the show in the United States in 2008, I'm sure they could have done a lot better than just letting the crisis happen right in front of their eyes. And when the crisis happened and they realized that they are in a systemic crisis, they came up with TARP. But at the beginning, the TARP was all about buying problem assets from the banks, which is not a solution at all. And I flew to Washington, told many people at the Treasury and Federal Reserve that, no, you don't buy up assets, you inject capital. Then if you inject capital, the capital works with a proper leverage, and then the banks can start functioning again. But I can tell you, in late September, early October, even the officials at the Treasury didn't understand any of this. It says, we're not going to be like the Japanese. We're going to do everything fine. Well, 3 or 4 weeks later, every money that TARP spent was spent on capital injection. So they actually learned in a pretty short period of time that that was the right thing to do. But many Japanese authorities were also warning the US officials that you have to inject capital as early as March of that year. But we were all brushed aside. Japanese did everything wrong. We're going to do everything right. Well, now they are doing what the Japanese have done. And furthermore, if you remember Treasury Secretary Geithner, who said, we're not going to be like the Japanese. We're going to clean up this mess quickly and move forward. Well, in October of 2009, I don't know how many of you are aware of this directive. It's a directive called Pretend and Extend. pretend that nothing happened, and continue lending to real estate developers. This directive, jointly issued by both Federal Reserve, Comptroller of Currency, and the FDIC, that's the one that stopped the crisis in the United States, 2009. The previous speaker mentioned about securitization and capital market and so forth. But when you look at what happened to commercial real estate prices, until that time, it's falling like a rock. But once the pretend and extend was issued, it stops, and then start recovering. So at that time, if you remember, a lot of us said after the housing, it would be commercial real estate, but commercial real estate never caused the problem because of this one directive, which told the banks that if there's any reason to believe that the borrower is still well, perhaps not solvent, but still can pay, then please continue rolling over his loans. That was the pretend and extend. Pretend that everything is fine and extend the loan. And after that was issued, the situation was stabilized. So the point is that, yes, US made a few mistakes at the beginning, but at the end, they came to their senses, realizing that this is a 95% problem, not the 5% problem, and putting in necessary realistic measures. And I don't see that in Europe at all. The European Banking Authority, the EBA, is asking banks, all of them, to raise capital from the private sources, when all of them have massive banking non-performing loans after the bursting of the European housing bubble. And some of the European housing bubbles are far bigger than the US housing bubble. So with that thing burst, all these banks are sitting on huge losses, non-performing loans, and EBA told the banks to raise capital. How do you raise capital when all the banks have the same problem at the same time? Most of them won't be able to raise capital, and whatever the capital they can get will be very expensive. And expensive capital is no capital at all. And so I have been very pessimistic on Europe ever since these EBA guys came along. And I'm afraid most of my forecast came true on that one because European economies are still suffering. So what can we learn from all of this? Well, I think there are a few things that Asia can learn from these experiences in the West. And that is that, and one thing that I really want to stress is that we need to formalize what kind of powers the authorities, banking authorities have in the case of systemic banking crisis. Because at the time when we were doing it at New York Fed, we didn't know whether it was legal or not. I mean, telling the banks to continue lending to Mexico, knowing fully well that Mexico is bankrupt, is that a legal power that you're supposed to have as a monetary authority or not? But we had to do it anyway under those circumstances. We had no choice. We did it, and then it worked out fine. But I think those things should be formalized so that when push comes to shove and you're in that situation, monetary authorities do have the power to tell banks what to do, and so that the whole system can be saved instead of forced into typical market fundamentalist type solution, which is not going to make situation any better. And just talking about resolution authority, I don't think it's enough. I mean, it's such a tiny part of the problem. In fact, what we need to do when you're faced with a banking crisis of this magnitude is to save all banks, not how to liquidate one, but how to save all. And I think those things should be specified so that authorities can just go ahead and do it without worrying about whether this is legal, illegal, or whatever. And the other thing is this excessive emphasis, in my view, on this too big to fail. Too big to fail is too convenient politically. You can just point fingers at this big, bad, nasty banks, rich, fat bankers, and then you point your fingers. Well, when you have banking crisis, the kind of crisis we had in 2008, it's not because Lehman Brothers was big, but everyone else had the same problem the Lehman had. That's why when at that time, no one could trust anyone else. I know you have the same CDOs. They know you have the same CDOs. No one knows what the value of these CDOs are. That's when the systemic banking crisis happened. And so just looking at a few big banks and this is systemically important, this is globally systemically important, this is politically too convenient. doesn't get to the core of the problem. The core of the problem is when all banks have the same problem at the same time, what do you do? What kind of authorities do you give to the the banking regulators or the central banks so that they can handle the crisis? And I really wish that, given what we just went through, Asian banking authorities will put in these measures in very clear terms so that if things do happen where all banks have the same problem at the same time, they know exactly what powers they have so that market will be assured and the situation won't go any further than it's absolutely necessary. Thank you very much.
I'm actually humbled to be on stage here with these distinguished speakers and more important, such a large and important audience. Some of you are my teachers. I know very well it is not because I have wisdom to share with you that brings me here. It is because my firm, PwC, is a knowledge partner of this important dialogue. Of course, the fault is mine, not PwC, if there's any error in my talk. Neither had I dreamed in my youth that I will be able to stand on this stage. The first Chinese sentence I learned to write is "Long live Chairman Mao." 毛主席万岁. The second sentence is, "We must liberate Taiwan." 我们一定要解放台湾. Imagine in 1970s, a young boy standing in front of a rural hut, which takes deposits from a few of his neighbor peasants, and have a communist slogan hanging in front of the hut, which says, "Put in your savings to support the construction of our new country." 积极参加储蓄，支持国家建设. What does this really mean? In 1980s, thanks to Deng Xiaoping's university admission policy that reopens university and admissions students based on test scores, not on class segregations, I started to learn abacus as a basic tool of accounting. Then I moved to Beijing and for the first time learned the concept of compound interest theory. And more important, for the first time, I learned that there is a price of money, CAPM. Ever since then, I go throughout Beijing airport. I look in the toilet and it says CAPM. It's not Capital Airport Property Management. I take it as capital asset pricing model. In late 1990s, my friend in the village where I was born, Mr. Yu Weijiao, started a business to deliver parcels and packages in Shanghai. His academic score in the school was not as good as mine. Hence, he has to start his life first as a carpenter in the village, and then as a migrant worker in Shanghai with a dream of living a better life. He now is the principal owner of Yuantong, the third largest logistic company in China. He hires IBM and PwC. And now he delivers 5 million parcels every day in China. Last year, he went to Beijing to ask for a payment license so that he can settle the purchases while delivering the parcels. Unfortunately, he was rejected. 90 kilometers away from my village where I was born, there is another man, a few years older than I am, and his name is Ma Yun. And he's no better looking than I am. He started a company called Alibaba. His company facilitates trades over internet, and his payment platform now attracts people to leave money in their accounts, which he pays a little bit better interest rates. Let us move our eyesight back to my village. In my village, there lives my father and my mother, and the people who are older than 50 years old and younger than 15 years. While I'm wearing this pair of shining Western suits and make a presentation to you here, my mother and my father and the people in the village have no access at all to any pension. Their only financial assets are cash and a small balance of bank deposits. Their house, in which generations of my ancestors live, are not their assets, as the land over which their houses were built has to be returned to the community government after their death. And I do not have a right to inherit that piece of land or house, as I now do not have residence permission or hukou in the village anymore. I paint this picture to you in this grand hotel of 4 seasons, in this financial hub of Asia, Hong Kong, to the whole purpose of asking you one question: what is the purpose of financial services? Second, if an institution that is defined as to hold exclusive power to enforce certain rules of social and economic conduct in a certain geographical area, that institution is called government. Hence, the regulator of financial services industry is part of the government's function. From my planned economy background and my communist education background, I have one definite conclusion to make: the government is not smarter than the market. As a communist educated young man, I know it from my heart that I am correct. When we're in search of a better regulatory framework, that's today's topic, I am concerned that we're in search of a too bigger and a much bigger and unnecessary regulatory model. I'm concerned about the over-regulatory reactions to the financial crisis. History has suggested that subsequent post-crisis regulatory reforms usually extend well beyond the original industry involved, and also beyond the original jurisdictions where all these problems start. As an accountant, if you don't believe, I can remind you of 2 words that is called Sarbanes-Oxley. A brief 2-paragraph section of the original bill is now a 300+ pages of regulations. Today, we've heard many words and references to the 3rd plenary session by Victor Fong, by Stuart Gulliver. I want to share with one quote from that plenary decision, that the market should be granted a decisive role in the allocation of resources, and the market should be given a great role in price determination. This is quoted from this book. It's called 中共中央关于全面深化改革日干重大问题的决定. This document perhaps will be as important as the manifesto of the Communist Party written by Karl Marx and Frederick Engels in 1847. If you leave a business card to me or to Victor Fong or to Andrew Sun, I will buy you a copy from Beijing and then mail it to you. It is in Chinese, 22,000 Chinese words, 60 pages. It doesn't matter if you don't read Chinese. The whole purpose for me is to remind to you that market is smarter than the government. And the communist China says that. Page 14 in this booklet, it says, we will build and enhance the beauty of yield curve that reflects the demand and supply of treasury bills in China. Page 14. Thirdly, when we look for a better regulatory framework, those who are in China should not be overconfident and nationalism focused. I know I'm facing the journalist, but I specifically say this to my Chinese colleagues now, which I perhaps dare not say it publicly in China. The high level of confidence in China is not particularly surprising, as there's much to feel good about over the last 30 years. In the wake of financial crisis, our banks, the Chinese banks, have climbed to the global league tables. However, the question is, did the Chinese banks emerge from the crash relatively unscathed due to skill or luck or circumstances? I would argue it was because of luck, pure luck. Luck because the government has just completed the cleanup of the balance sheet of the banks. Luck because we have not yet those complex financial instruments that you have. Luck because our banking system is totally cut off from the global markets because of controlled interest rate and exchange rate. When we at PwC helped the Chinese banks to clean up their balance sheet in 2002, 2006, and strengthen its corporate governance, our asks is for the bank CEOs and the chairman to separate from the government officers. After the financial crisis, and with the 4 trillion renminbi stimulus package, the bank's officers started again to often dine and eating with the provisional governors and extended lendings to special government financing vehicles. The Chinese government officers and the banks sometimes start to laugh at their Western counterparts and say, we should have confidence in our theory, in our own theory. We should have confidence in our own roadmap and in our own system, while in reality, the Chinese banks have never really experienced one cycle of economic recession. Lastly, 3 months from today, in March 2014, as a qualified Chinese CPA, I'm going to sign off 3 balance sheets of their respective banks headquartered in Beijing, exceeding total assets, exceeding the maybe 20.6 trillion, roughly US dollars 3.3 to 3.4 trillion. When I sign off this balance sheet and report to their owners and say, these balance sheets truly represent the financial condition of the banks, remember one fact that keeps me awake all the nights. These numbers are all historical, and they become useless when they are presented to their owners. The owners of this balance sheet ask one question: what will happen tomorrow? Those numbers I certified will not answer that question. As an auditor, I ask myself, what is the relevance of my job? If I cannot provide value to the owners of these balance sheets, why should they pay me as an auditor? Have our regulators ever asked that question? After all, they are paid by the taxpayers. If you remember nothing else today from my little talk, remember 2 questions. What is the purpose of financial services? Second, is my job relevant to a strong financial service sector? And more importantly, is my job as a regulator relevant to the real economy? Thank you.
Well, my few words are I have nothing to say after that. That could come close to matching the impact of what has just been said, so I won't say any more. Thank you.
Andy, just maybe just to start with some questions. I think you spoke about being from purgatory to heaven, which is, I think, what all of us feel about being in Hong Kong. And you spoke about Basel III, Asia 4 as the football result. You've spoken a lot on Basel III, and you've written a lot in terms of talking about the Tower of Basel in one of your speeches, and your idea that complexity in finance requires simplicity in regulation applies to developed markets like the US and the UK. Does the inverse apply to Asia?
So this point about complexity did come home to me over the last 2 days. I mentioned the Basel Committee meeting I've just come from.